And then let's look at question 6. So you're considering a new project whose data are shown below. What is the project's year one cash flow? So we're just doing kind of part of one of these huge capital budgeting project analysis items here. So here I have to kind of write down my standard stuff. I need to figure out, basically I need earnings before interest and taxes, take out taxes, and add back depreciation to get cash flow 1. So I have sales minus operating costs minus depreciation, because we have to use that to get our earnings before interest and taxes. And then we subtract out tax, and that leaves us with earnings before interest and taxes basically times 1 minus the tax rate is what that is. And then we add back depreciation, and then we get the cash flow at time 1 is equal to something. And so we look at, so they've given us sales revenues, and that was 25,500. Operating costs were right here, 12,000. So I'm going to subtract that, and depreciation was 8,000. So I'll subtract that. And so if I subtract those two, I get an earnings before interest and tax of 5,500. And then to figure out my tax, I'm going to go up here and multiply 5,500 times the tax rate of 35%. And so taxes end up being $1,925. So I'm going to put that here, minus 1,925. And so EBIT minus taxes is 3,575. And then I add back depreciation from up here, the 8,000. And then I get my cash flow at time 1, which is 11,575. And that's answer D. So anytime you see a question like that, this is exactly the way that you would do this. And so let's go into the next question, question 7, and there are just 8 questions. So 7 says, Liberty Services is now at the end of the final year of a project. The equipment originally cost $10,500. So we're dealing with, if you kind of see this information, I know we're dealing with a salvage value type question. And you can actually see, if you look towards the end, what is the equipment's after-tax salvage value for use in capital budgeting analysis? So the equipment cost $10,500, of which 75% has been depreciated. And they're giving us that information because we need to find the book value of the asset. And then the firm can sell the used equipment today for $6,000. That's the market value, and its tax rate is 40%. So we kind of have several different steps. Step 1 would be to find the book value of the asset, and that's just going to be 10,500 times 1 minus what's been depreciated, or basically we need 25% of 10,500. And so the book value is 2,625. Then we need to figure out, if that's the book value, are we selling this equipment at a gain or at a loss? And we know it's going to be a gain because the market value is 6,000. So is this a gain or loss? And here we would take the market value minus the book value. And so the market value is 6,000 and the book value is 2625, and so we see that will be a gain of $3,375. And so that's what the company will be taxed on, is a gain on selling this what they call it, equipment. And then the next thing that we need to find is the tax on the gain. And so we would take the 3375 times the tax rate of 40%, and that would leave us a tax that we have to pay, or the company has to pay, of $13.50. And so let me fix this real quick. Then the fourth part is to figure out what they want, the after-tax salvage value. And so what we do here is we just take the market value plus or minus the taxes. And so since we have actual negative, we have taxes we have to pay, it's a minus. So the market value is 6,000 minus the taxes of 1,350, and we get 4,650. And that's answer A. And that's the after-tax salvage value. We would include this at the end of the life of the project. So if it was a 4-year project, we would add 4,650 at year 4 to the cash flows. Okay.